All right, welcome back to another AutoTrend system trade review video. In this video, we're going to look at Forex. I've got a lot of requests by our members to create some videos showing how the ATS works in Forex, in the Forex markets. So we're gonna go ahead and do that today. Of course, the ATS works exactly the same way on all markets. So there won't be many differences here, but let's go ahead and have a look at this series of trades, this series of short trades that happen in the British pound US dollar pair on the 30-minute chart using the AutoTrend system tools. In this video, we're going to be using all three different tools. We're going to be using the AutoTrend system, the dynamic profit levels, and the trend validator, all together to help us form a concrete plan and strategy to take advantage of this really big downtrend that unfolded on British pound USD dollar and potentially capture a max profit of 290 pips. Obviously, how much that is in monetary value, that depends on your account size. So let's go ahead and do that. What I'm going to do is I'm going to focus on this area right here because that's the start of our trades. Why is that the start? Well, let's break it down. So we know that the trend validator is red. That tells us that the British pound USD dollar on a higher time frame is going down, right? So it's currently on a downtrend. So anything previous to that, so this uptrend here, we wouldn't be really interested in it. We will not be taking these blue signals here because the trend validator is red. So we're automatically excluding 50% of the signals from our chart. We're only interested in taking short signals on our time frame because the trend validator is red. By the way, I am using the 4-hour chart for my trend validator settings, because I wanted to be displaying the ATS trend of the 4-hour chart right under my 30-minute chart so that I can be doing very quick multi-time frame analysis right on the chart without having to switch back and forth and confuse myself. So it's a very useful tool to have on your chart when you're trading with the ATS. So let's start here. What happened here is basically we got a trend change by the ATS. The bars changed from blue to red, and this big long candle is the one that created the trend change. So we call this our signal bar. This is the signal bar. That's the bar that gave us our signal. As always, we need to wait for the bar to fully close, before we can consider a potential entry. Now, unfortunately, not every scenario is perfect. Unfortunately, this bar is quite long. I prefer when we have smaller range bars. Let's say something like this would be more ideal here. You see, something like this would have been better because this would require a smaller stop loss. But we don't always get that. We often get it, but we don't always get it. In this case, our entry needs to be when a next bar, either the very next bar or the subsequent bar, when we break below the lows of the signal bar, just like always. So my entry would be here, and the stop loss needs to go either. And this is where we can do things a little bit different. When I have a really long range bar like this one, I can place my stop loss just above the high of this bar. Usually you will see me placing my stop loss behind a prior swing high. So just above a prior swing high would be here. You see price went up, and then down again. So that's the previous swing high. But since our signal bar is so wide, so it's very, very long, which means that we have enough space for our stop loss to be there. If it was a very small bar, a narrow range bar, then of course we would be placing above a prior swing high. But in this case, it gives us a lot of space for the stop loss to do its work, basically to protect our trade from sideways action. So I would have placed it there in this scenario. If not, again, it would be just above a prior swing high like I normally like I normally do. And the profit target, of course, is the first dynamic profit level here. This gives us a potential reward of 1 to 1. Right, very simple. Obviously, as you can see, we did not end up reaching this profit target. Price reversed before that and went up and gave us another trend change. So what do we do there? Let's see how I would have managed this trade in real time. So obviously we were in profit for quite some time. That's fine. And it ended up going all the way back up. So that's okay. Very often in trading, especially with trend following systems, you will be in open profit and you will end up seeing that profit coming back to zero or a slight stop loss. That's just part of the game, and you need to sit through those scenarios if you're going to last in the game of trading. That's just the reality. So we get another trend change signal here, and since we are short and this is a buy signal, we need to exit our short trade at that point. So we're exiting our short trade for a stop loss that was around, let's say, 50 to 35% of our original risk. So let's say here we risked $1,000 on this trade. We would have stopped out for a potential stop loss of around $350. So that's around 35% of our initial risk. Okay, and that's the end basically of that trade. We are not interested in taking this signal long because the trend validator is still red. We're only interested in short signals. So what happens next? Well, we get another short signal right here. We get another short signal. The entry goes just below the low of that signal, and the stop loss needs to go just above right here, above the prior swing high. And again, we are targeting the next dynamic profit level here on our chart. So that's a good risk reward of 2.5. So we're risking, let's say, $1,000 to make 2,500. That's a good risk reward. Obviously, we didn't end up getting this. What happened next was we got another, let me zoom in here so you can really see it. Right here, we got another buy signal here. You can't see it because I'm hovering over with my mouse and we get this pop-up, but you can see that there is a buy signal there and it closes right here. So at that point, we need to exit our short trade again for, once again, around a 40% loss than we had originally planned. So if we had planned to risk $1,000, we just lost 400 in that example. And that's fine, no problem there. We're not interested in getting this buy signal, so we continue following with the trend and continue taking our signals, following our rules, stopping out when we need to, so that we can be in the trade when the bigger move happens. We don't know when it's going to happen, but we need to stay with the market until it happens, always managing our risk and always managing our trades. So here's what happened next. We got another short signal here at the end at the lows of this bar. We can go long, short there. Our stop loss needs to go just above the high of the previous swing high, and again we are targeting as our first profit target. As our first profit target, we are targeting the dynamic profit levels right there. That's the first profit target. Of course, we can hold for longer than that. So what happens next? Very clear. We end up not getting this because we get another stop out here. We get another buy signal at this point. We have caught ourselves up in quite a sideways action. No problem. We just need to manage our risk and manage our trades. Again, very similar scenario, and you will see this very often with the ATS. You had originally planned to stop out here, potentially lose $1,000, but you're getting a quicker signal by the ATS to get out for a smaller loss. So it's saving you money that you don't have to lose all of it, right? So in this case, we're stopping out here for, again, around a 50% stop loss. That's fine. plan to risk $1,000, we lost $500. So at this point, with 3 stop outs in a row, we are down about, let's say, $1,200 in total. And that's fine. We're not following this buy signal. We're only interested in short trades. And then we finally get this signal right here. And here's what happens in this case. We're going short here, right here, okay? And we need to place our stop loss just before the previous swing high. Now, how you judge that can be a little bit subjective. So we have a swing high here. Let me mark it. We have a swing high right here, but we also have this swing high here. This is also a swing high. It's very close to the entry, right? It's very close to the entry, but it's still a swing high. And according to our rules, we need to place our stop loss just behind the prior swing high to minimize our risk, right? But in this case, it's very close. Now, I can't place it above here, but that's a little bit too far in relation to just the previous swing high. So what I would do in this situation, what I often do, is I place it right in the middle. This way I'm in a good range. I give the trade a good amount of space for it to work in my favor before it finally gives me the move that I want. It moves in my direction. So I would place it around there. And then, of course, as always, we're targeting exactly the same place for our first target, which is the next dynamic profit level right here. And finally, price exited this annoying but normal sideways price action and gave us the move that we wanted. Now, in this case, we're always risking the exact same amount of money. So in each trade, we risked $1,000, $1,000 here, $1,000 here, $1,000 here. We ended up stopping early on all 3 of those exits. So we lost about, let's round it up and make it $500. And then we finally caught this big move down. And that was a risk to reward of 1 to 7. So we risked $1,000 to make $7,000 in this case. So what happened overall? Overall, we lost about $1,500 in the sideways market action. And then we made $7,000 when we finally caught the trend down. So in net profit, we're up $5,500 in net, right? So that's basically the reality of trading a trend following system in real time without the hyperbole, without hiding the realities of trading, which is, yes, you are going to get caught up in sideways action. What's really, really important is having a system in place that you can follow to protect you when the inevitable choppy action unfolds, right? You cannot predict which signal is going to give you the big move down. And in the beginning, here, we thought that this would be the signal, right? We got some follow through, we were happy, and then we ended up cutting it for a small stop loss, right? So you can never predict which one of those signals is going to lead to the big move down that we've seen here. That's impossible. What you can do, what you can control, is your risk and your rules. If you do those things, you will be successful with this method and with any other, as long as you have very, very clear rules. And that's what the ATS is so good at. It gives us really crystal clear rules that we can follow, and we can do it consistently over and over again and on any market. I think I've made about over 10 videos now on my YouTube channel with other trade review videos, and you will notice that they're all basically the same. I'm following the same rules. It's only a matter of a different market or a different time frame. Sometimes I might be trading stocks, futures, in this example Forex. Sometimes I'll be trading the 30-minute chart, the daily chart. Sometimes I'll be trading the 1-minute chart. The rules don't change because price action does not change. Price action is fractal. So whatever you see in one time frame, you will see it on another, and it will not make a difference. If I hide here which time frame I'm using, you wouldn't be able to tell the difference. So it's really a matter of your preference. Do you prefer to be in trades for longer? Do you prefer to be in trades for a shorter amount of time? In and out. How much time do you have? When can you trade with your schedule? It doesn't really matter. Just pick a time frame, pick a market, and follow the rules. It's really, really as simple as that. Lots of people overcomplicate it, unfortunately, simply because they think it's complicated, or they're trying to sell you things you don't need. Trading, in my opinion, is quite simple. You just need to have a system that you can follow consistently, such as the AutoTrend system, but of course you can create your own. So coming back to the trade, so this was our first profit target, and you can stop everything there. You can take your profits. That's a very good $7,000 profit. Again, I'm following up with my example of risking $1,000. Of course, you can risk $10,000, you can risk 100, and you will size accordingly. That's of course explained in the video course on my website as well. So let's say we risk $1,000. We're here where we made a nice profit of $7,000, and we're out of this trade. Net profit with our losses included, prior losses, that's around $5,500, a little bit more because these were a smaller stop outs than 50%. But anyway, let's just round it up to 5,500. And then we drop down to the next dynamic profit level right here. That's our next target. That's our next target. And you can hold for that one as well. You can see, by the way, how nicely price is reacting to each one of those levels. That's not by coincidence. Basically, the DPL is a very effective tool. It's a leading indicator, basically. It's not lagging price. It is mathematically calculating very strong, potentially strong support and resistance levels. Now, we are not trading support and resistance. You can if you want to develop your own system. I'm primarily a trend follower, but I use those levels to get me out of trades ahead of time, right? I'm not waiting for an opposite signal to exit, because by that time I would have given up a lot of potential profit until I get a buy signal to exit my short trade, right? So I'm using those indicators as a leading signal that the price is potentially, has a high likelihood of reversing there. And I don't want to be in a short trade if it bounces and reverses short, as we have seen here, for example, right? So I'm taking profits whenever there is a DPL, whenever price hits a DPL, a dynamic profit level. So I'm out at that point for a nice profit. Now you can, what I advocate oftentimes is just split your profit levels, right? So you can take 50% of your trade here off. So you take profits on 50% of your trade, and then another 50% on the next dynamic profit levels. So you're allowing yourself to capture a bigger move if it unfolds, or at least capture some profits if it only ends up going down to here and then stopping at the rest at break even. So that's up to you, right? So that's there, and then obviously it ends up going down to here. Now that could be your third potential profit level. Now, just to be conservative, we were targeting just the first one for a 1-to-7 risk-reward ratio, so we're risking 1,000 to make 7,000. If you were targeting the second dynamic profit level for your entire position, that would be a risk of $1,000 to potentially make 22,000, because that's a risk of 1 to 22. Obviously, that's a much bigger target, but the likelihood of hitting it is smaller. So it is a trade-off. Do you want to go for bigger targets and take small losses along the way to capture the big one? As we saw here, that's a very realistic way of trading, and that's just the reality of a trend following system. Then it's only a matter of, okay, what kind of profit, what kind of target are you most comfortable with to wait for? That's a matter of personal preference. Usually, most of the time, I will either take all of my profits at the first or second dynamic profit level, or I will split those trades 50-50 basically. So I will take 50% off on the very next dynamic profit level, and 50% off at the second one, right? So then for me it's more comfortable, right? But it really is a matter of preference on what you feel most comfortable with. That's just the way that I trade. Okay, so I think that pretty much covers it. So that was an example of using the ATS on a Forex pair. As I said in the beginning of the video, you can use it on all markets. It doesn't really matter. All markets move the same. All markets move the same. There are many people that will tell you that's not true. There are differences. And there might be some slight differences, of course. But when it comes to price action, just pure price action, you will notice I'm not using anything else. I'm not taking into account news. I'm not taking into account time of the day, economic factors, fundamentals, none of that. I'm not listening to any of this, and I'm not doing any preparation before I sit down and look at my charts. I'm not doing any other form of preparation. I follow the signals, I follow my rules, I always stop out when I have to, and I always wait for my profit levels to be hit. It is the most systematic and objective way to trade that I personally know of. I've developed it over the years and it works just really, really well. And there's absolutely no reason to overcomplicate things. When you start overcomplicating things, you start introducing unknown factors into your trading, you start introducing subjectivity, and that can come with many, many errors of judgment. And that's a much harder way to trade. And unfortunately, it's something that a lot of newer traders get caught up in. I know that I did when I started trading in the first couple of years of my career as a trader. I did that, and I ended up going nowhere. Basically, I was a losing trader. It's only when I started trading with a very, very systematic way of doing things that I started seeing success and consistency. And that's basically what you want as a trader, right? So, all right, I think we'll cut it here. Thanks for watching. If you want me to make videos on other markets or other time frames or anything else showing the AutoTrend system toolbox in action, let me know, and I'll go ahead and do that. All right, so again, thanks for watching, and take care.